Hey guys, Felipe here. Hope everyone is doing awesome. So, as you know, I'm here to keep you up to date with current market news and teachings as well as education. So, in this video, I'm going to be talking about options, specifically the option Greek Vega, which basically is a variable that affects the pricing of options, right? Which is typically volatility, right? So, I'm just gonna go ahead and jump into it. So here we're gonna start off by looking at just basically the VIX index, volatility index for the S&P 500. So basically what this is the inverse the S&P 500, right? So when the S&P 500 is going up, this goes down. Why? Because this just basically indicates our investors purchasing portfolio insurance on the S&P 500 via puts, or are speculators buying a lot of those, or just basically it's the inverse, right? When this thing goes up, the S&P goes down. So typically, or historically, when this is under 10, it's rare, and rare in a negative way, because it usually means that at some point in the near future, the S&P 500, it's going to possibly go down, and this is going to spike, right? Historically, right? Which is no indicator of the future, but that's what it's been historically in rare cases when that does occur. And the VIX is pretty low considering, which makes sense because the market is up, right? And here we have the VXN, which is the VIX for the NASDAQ 100. And then again, there's volatility indexes or volatility indicators for any kind of vehicle really these days, whether it's indexes, stocks, commodities, and so forth. But in this case, this is the VIX for the NASDAQ. Same similar concept. It functions the same way as the VIX for the S&P. It's an indicator of our people purchasing portfolio insurance against NASDAQ because they're, protecting themselves in case it does decline, right? The NASDAQ, and so forth. And then lastly, we have the RVX, which is the volatility index for the Russell 2000. Same concept here. It's the volatility indicator for the underlying of the Russell 2000, which is the 2000 small caps to mid caps in the US, right? It's another one of the big indexes in the US, or one of the benchmarks, right? So to switch gears here, I'm just going to go straight into it. And here we have the option Greeks, right? Beginning with, this is just kind of an understanding of log normal distribution, which is, in my opinion, false. It basically is what commonly used to describe stock prices because it shapes, is intuitively similar to the way stock prices behave, in the sense that they cannot go below zero, and they can rise to infinity, right? And most of the time, they don't go much of anywhere. On top of that, the distribution shape is based on historical volatility of the underlying instrument and a log normal distribution, the normal distribution so stocks remain within 3 standard deviations of their current price 99.74% of the time. So that means they're not supposed to be very volatile 99.74% of the time. And this is basically a standard deviation, is a statistical measure whose absolute distance grows larger with time. And it is something that can be easily calculated for any individual stock or future contract using historical prices. The problem lies in assuming that normal distribution predicts stock price movements. 3 standard deviations is a 0.0013, or just a little more than 0.1%. So if there are 2,500 optional stocks, say, then one would expect maybe 3 of them to move 3 standard deviations on any given day. So standard deviation is just basically volatility, right? Standard deviation, which that little symbol there is the Greek letter sigma, which mathematicians use to denote standard deviations. The only way to tell how many standard deviations a stock has moved is to use It's historical volatility, say the 20-day historical volatility, for example, in the measurements. Terms to kind of understand, just so this kind of makes sense, because I know this is a lot of like industry lingo, right? So out of the money, basically describing an option that has no intrinsic value. A call option is out of the money if the stock is below the striking price. It's a call, while a put is out of the money if the stock is higher than the striking price of the put. In the money, an option has an intrinsic value. For a call option is in the money if the underlying security is higher than the striking price of the call. A put option is in the money if the security is below the striking price, right? Because in the call, you're expecting the stocks to rise. So therefore you're setting a strike price that is above the actual value of the stock. If the stock surpasses that, the call's in the money, right? And then the opposite for the put, right? Intrinsic value, the value of an option, if it were to expire immediately with the underlying stock at its current price, basically means does the stock have, does the option contract have any actual value, meaning profit? The amount by which the option is in the money. For calls, this is the difference between the stock price and the striking price. If that difference is a positive number or zero otherwise, because otherwise you make no money, right? For put options, it is the difference between the striking price and the stock price. If that difference is positive or zero otherwise, right? So that is a couple of terms there. Again, put, an option granting the holder the right to sell the underlying security at a certain price for a specific period of time. A call, an option that gives the holder the right to buy the underlying security at a specified price for a certain fixed period of time. And then time value premium, the amount by which an option's total premium exceeds its intrinsic value. So does that option actually have any value, basically? So we're going to be talking about volatility. This is some terms to be familiar with that are good stuff to know. So volatility skew is basically the term used to describe a phenomenon in which individual options on a single underlying instrument have different implied volatilities. In general, not only are the individual options implied volatilities different, but they form a pattern. If the lower striking price have the lowest implied volatility, then implied volatility progresses higher as one moves up through the striking price. This is called a forward or positive skew. A reverse or negative skew works in the opposite way. The higher strike have the lowest implied volatility. So that is a volatility skew. And then here's just basically a strategy for the use of volatility, right? Which is the volatility backspread. Basically, the volatility backspread involves selling a long term at the money, just as in the reverse calendar spread, and then buying a greater number of near term out of the money options. The position is generally constructed to be a delta neutral, and it has a negative Vega, meaning that it will profit if implied volatility decreases, whereas typically just long options, whether calls or puts, they lose money when volatility decreases. So this is basically the ability to make money when volatility decreases, right? Or someone can call, volatility crusher or whatnot. Delta neutral, that is to have a equivalent stock position or equivalent future position be zero. So it's kind of like you're not bearish or you're not bullish, you're kind of neutral. That's basically what it means. A delta neutral position is one in which the sum of the projected price changes of the long options in the spread is essentially offset by the projected price changes of the short options in the same spread. Delta neutral is not entirely neutral. In fact, delta neutral means that one is neutral only with respect to small price changes in the underlying security. A delta neutral position may have seriously unnatural characteristics when some of the other risk measurements are considered, which are the other Greeks, right? Like delta, gamma, rho, and theta, right? When those change, the position basically can no longer be delta neutral. Delta, which is very important for options to understand. Delta of an option is actually a fair good estimate of the probability of the option being in the money, and at its expiration date. So you can use it as like a percentage of the probability of that option contract being in the money, before or at expiration, which in the money means, right, you've made a profitable investment or speculation, right? Thus, delta in the simple endpoint probability calculator attempts to convey the same info to the trader in reality because of the fact that implied volatility might be different for various strikes. And then again, that's the volatility skew. Especially in index options, the delta of the option might not agree exactly with the probability calculator. Even so, the delta is a quick and dirty way to estimate the probability of the stock being above the stock strike price in the case of call options, or below the strike price in the case of put options at expiration, right? Because put options, when you're long, you're betting that the stock's going to decline, right? So now let's get to the good stuff, volatility, right? Volatility trading is both an art and a science. It is based on comparing today's implied volatility with what one expects volatility to do in the future. The approach that traders agree upon is this: if implied volatility is low, buy it. If it is high, sell it with caution. Again, these are just rules of thumbs because implied volatility can remain low for very long, or it can remain high for very long. Determining when volatility is out of line, first compare implied volatility to its own past levels, percentile of implied volatility. Two, compare implied volatility to historical volatility. So implied volatility is the expectation of future volatility. Historical volatility is what has already occurred, right? And three, interpret the chart of volatility, which is kind of like what I first showed some of the charts. Volatility is a measure of how quickly the underlying security moves. Statistically, it is usually calculated as the standard deviation of the stock price over a period of time, generally analyzed. The statistic measure is expressed as a percentage, although relating that percentage to the actual stock movement can be complicated. Suffice to say that a stock has a 50% volatility is more volatile than a stock that has 30% volatility. The stock market generally has a volatility on average of 15% overall, although that may change from time to time, and that would occur during crashes and so forth. So an increase in volatility is not good for a position with naked options in it, right? And then just basically, there has been several times in the recent past, mostly during market crashes, when implied volatility on both indexes and equity options have leaped tremendously, because that's usually when volatility explodes, right? When there's a pretty nasty decline in the market, right? For that specific volatility index. However, basically in those times, it was not kind to sellers of options. So either selling calls or selling puts, right? Those are naked option positions. However, in almost every case, the implied volatility of an index option was quite low before the crash occurred. Thus, any trader who was examining his Vega risk would not have been inclined to sell naked options when they were historically cheap. Kind of like now, volatility is very low, right? So it's kind of, you got to be careful with those naked options. Historical volatility measures how fast an entity, a stock, for example, has been moving around in the past. So it's the past volatility, basically, historical. Implied volatility, on the other hand, is the options market's estimate of how volatile the underlying is going to be during the life of the option. It is a forward-looking estimate, basically, or measure. It's what investors or speculators are estimating that volatility is going to be in the future during the life of that option contract, right? And then now we're getting into Vega, which is one of the Greeks. Here you have Vega's Greek symbol, which is a V, Vega. So Vega is the amount by which the option price changes when volatility changes. Vega is always expressed as a positive number, whether it refers to a put or call. It is known that more volatile stocks have more expensive options, right? So the more implied volatility, the more expensive that stock and that option contract is going to be, right? Thus, as volatility increases, the price of the option will rise as long as you're long, whether long call or long put. If volatility falls, the price of the option will fall as well. In that case, it could be volatility crush, right? The Vega is merely an attempt to quantify how much the option price will increase or decrease as volatility moves, all other factors being equal. So Vega is related to time, which is another one of the Greeks, theta, time decay. As a measurement of risk, Vega can refer to the option itself, option Vega, or to the position as a whole, position Vega. Since Vega is expressed as a positive number, if one is long options, then his position Vega will be positive. This means he has exposure to volatility decreases, right? Which is volatility crush. You can lose a ton of money if that occurs to you, or can make money if volatility increases. Vega is greatest at the money options and approaches zero as the option is deeply in or out of the money. A deep in or out of the money option will not be affected much by the change in volatility. In addition, for at the money options, longer term options have a higher Vega and short-term options than short-term options. Vega does not directly correlate with either delta or gamma. So it's not correlated to that, but it is correlated to time decay or theta. So here we have a quick example of kind of how volatility works, right? So let's assume that there's a stock called XYZ, and XYZ is currently at 49. And the January 50 call is selling for 3.50, right? Which that is $350. How you basically equate that to dollars, right? So someone purchases that $50 call, and the Vega of the option is 0.25. So the actual variable Vega is 0.25. And the current volatility of XYZ stock is 30%. So basically, if volatility increases by 1%, so it goes from 30% to 31%, then the Vega indicates that the option will increase in value by 0.25 to 3.75. So that call, that January 50 call, its value goes from 3.50, so $350 to 3.75 or $375, right? Because it had increased by the 0.25, which was the Vega, right? Or the Vega variable. If the volatility has instead decreased by 1% to 29%, then that January 50 call would decrease by that 0.25 that the Vega is, right? So it would drop down to 3.25, which it would now be worth $325. So basically, in this scenario, for every 1% move in volatility, whether up or down, it's either a potential gain of $25 or a potential loss of $25, because Vega is 0.25, right? So that's gonna affect the pricing of that option. And then this is a pretty cool quote. Panic is in its nature unreasoning. Therefore, although the financial fright of 1893 arose from the fear of depreciation of the legal tender, the first act of frightened banks depositors was to withdraw these very legal tenders from their banks, which caused the kind of bank panics back then in 1893. And here we have some tickers in case you're interested in observing and kind of learning a little bit more about volatility. Here we have a bunch of different tickers available, right? So we have VXN, which I kind of showed initially, RVX, which I kind of showed initially, the Russell 2000, VIX, VXD, which is the volatility index for the Dow, IUG, implied VIX, implied volatility for VIX variance future derivatives. Wouldn't play around with that. That's some dangerous stuff. RUG, which is realized VIX variance volatility for the VIX variance futures. VWB, which is VIX bid. VWA, which is VIX ask, right? Bid and ask. VXX, which is provided by Barclays Bank, which they are big in the market. XIV inverse VIX, SZIV inverse VIX and skew to basically see the skew of the S&P 500, and XVIX, which is the VIX term structure. Kind of gives you an idea of whether VIX is in a positive slope or in a negative slope. And I can go deep into that, but I'll leave it there for now. So cool. Here, with that being said, thank you guys for watching. I hope you gained some value from this. And if you did, feel free to like and subscribe. I really appreciate that. Thank you guys for watching, and I'll catch you on the next one.